In January 2019, WeWork, a company that leased and subleased office spaces, achieved a breathtaking valuation of $47 billion, making it one of the world's most valuable startups. Yet, just 4 years later, in November 2023, that empire filed for Chapter 11 bankruptcy. This dramatic journey from a perceived tech visionary to a real estate casualty is a profound case study in ambition, market hype, and the brutal realities of financial sustainability. How did a company designed to revolutionize the workspace end up in such a spectacular collapse, dragging billions in investor capital with it? The answers lie in a complex interplay of a charismatic founder, an unsustainable business model, and unchecked growth. At the heart of WeWork's initial appeal was its co-founder, Adam Neumann, a figure of boundless charisma and evangelism. Neumann didn't just sell office space, he sold a vision of community, a movement where people came to make a life, not just a living. This narrative resonated deeply in the startup world, offering flexible workspaces designed to foster collaboration and culture, complete with kombucha on tap and trendy aesthetics. This perceived vibe was crucial, allowing WeWork to differentiate itself from traditional landlords and attract a rapidly growing base of freelancers, startups, and even large corporations seeking agile office solutions globally. Stripping away the community rhetoric, WeWork's fundamental business model was remarkably simple, yet ultimately precarious. The company would sign long-term leases, often for 15 years or more, on large commercial properties. They would then invest heavily in renovating these spaces, transforming them into stylish, amenity-rich co-working environments. Finally, they would subdivide these revamped offices into smaller units and release them on much shorter, flexible terms, typically monthly or yearly subscriptions, to a diverse clientele. The profitability hinged entirely on the margin between their long-term lease costs and their aggregate short-term revenue, requiring constant occupancy and minimal downtime. Crucially, Adam Neumann fiercely branded WeWork not as a real estate company, but as a technology company. This distinction was not merely semantic, it was central to its astronomical valuation. Traditional real estate firms are valued on tangible assets and cash flow, commanding lower multiples. Tech companies, however, are valued on potential, market disruption, and user growth, often achieving far higher valuations. By positioning itself as a platform leveraging technology to optimize space and community, WeWork aimed to tap into the venture capital mindset that powered giants like Uber and Airbnb, justifying investor expectations of explosive, unbounded growth and sky-high returns. Fueled by this tech-driven narrative and massive investor capital, WeWork embarked on an aggressive, global expansion strategy. The mantra was growth at any cost, prioritizing market share over profitability. The company rapidly scaled, opening hundreds of locations across dozens of cities worldwide. This insatiable appetite for expansion meant signing more long-term leases and burning through billions in investor cash to fund lavish build-outs and attract new members with subsidized rates and perks. At its peak, WeWork operated over 700 locations in more than 120 cities, managing millions of square feet under lease, a testament to its breakneck pace of expansion. The most significant enabler of WeWork's explosive growth was SoftBank, led by its enigmatic founder, Masayoshi Son. Son, known for his vision fund and a willingness to make colossal, often speculative, bets on disruptive technologies, saw WeWork as a revolutionary force. He poured billions into the company, becoming its largest investor. Son famously encouraged Neumann to think even bigger, to expand faster, and to dominate the global flexible workspace market, believing that sheer scale would eventually lead to profitability. This immense capital infusion allowed WeWork to sustain its cash-burning growth model far longer than it otherwise could have. The partnership culminated in January 2019, when a new funding round, predominantly from SoftBank, officially stamped WeWork's valuation at a staggering $47 billion. This valuation wasn't just a number, it represented a pinnacle of investor confidence and market euphoria. WeWork had become the darling of the startup world, a unicorn among unicorns, seemingly validating Neumann's vision and SoftBank's investment thesis. However, beneath this glittering surface, the fundamental economics of the business remained challenging, and the path to profitability was increasingly obscure, hidden by the relentless pursuit of growth and the promise of future technological leverage. In August 2019, WeWork announced its intention to go public, targeting that same $47 billion valuation. This was meant to be the crowning achievement, the liquidity event that would cement its status and reward its investors. However, the scrutiny that comes with an IPO filing proved to be the undoing. Public market investors and analysts began to delve into the S-1 prospectus, revealing deeply concerning financial metrics and corporate governance issues. The document highlighted massive losses, an unclear path to profitability, and an alarming level of control and self-dealing by Adam Neumann. The tech company narrative began to crumble under the harsh light of traditional financial analysis. Adam Neumann's actions as CEO raised significant red flags. It was revealed that he owned buildings and leased them back to WeWork, creating a blatant conflict of interest. Perhaps even more controversially, he trademarked the We brand and then sold the rights to his own company for $5.9 million. These instances of self-enrichment and questionable corporate governance painted a picture of a founder leveraging his position for personal gain, rather than purely serving the company's best interests. Such disclosures eroded investor confidence, suggesting a lack of accountability and a disregard for ethical corporate practices, making a successful IPO increasingly untenable. At its core, WeWork's business model harbored a critical vulnerability: the mismatch between its long-term liabilities and its short-term revenue streams. WeWork was committed to 15-year leases with landlords, guaranteeing payments for years to come. Yet, its primary income came from members who could cancel their monthly or yearly subscriptions with relative ease. This structural imbalance made the company extraordinarily susceptible to economic downturns. In a recession, as startups fail and larger companies cut costs, members would flee, leaving WeWork saddled with expensive, long-term lease obligations for increasingly empty spaces, a scenario that quickly materialized. The public backlash and investor skepticism proved overwhelming. WeWork's planned IPO, once a certainty, collapsed under the weight of its own flawed financials and governance issues. In September 2019, just weeks after filing its intent to go public, the company was forced to withdraw its IPO application. The market's revised assessment was brutal. Within a single month, WeWork's valuation plummeted from the ambitious $47 billion to a mere $10 billion. This precipitous drop of over 75% was a clear signal that public markets were unwilling to underwrite the aggressive growth-at-all-costs strategy that private investors, particularly SoftBank, had so eagerly embraced. With the IPO debt and WeWork bleeding cash, SoftBank was forced into an uncomfortable position. To prevent a complete meltdown, it had to orchestrate a massive bailout package. This intervention saw SoftBank inject billions more into the struggling company, acquiring an 80% stake and effectively taking control. As part of this drastic restructuring, Adam Neumann, the charismatic founder who had driven WeWork to its dizzying heights, was unceremoniously ousted as CEO in September 2019. It was a stark admission of failure, not just for Neumann, but also for SoftBank's initial investment thesis and its oversight of the company. The aftermath of Neumann's ousting revealed another deeply controversial aspect of WeWork's saga: his golden parachute. Despite presiding over one of the most significant startup implosions in recent memory, Adam Neumann walked away with an exit package reportedly valued at $1.7 billion. This staggering sum included a mix of a consulting fee, a credit line, and the ability to sell his remaining shares. For many, it highlighted a profound disconnect between executive accountability and reward, where the founder of a company driven to the brink of collapse by his own management decisions could still receive an astronomical payout while investors bore the brunt of the losses. Even with Neumann gone and SoftBank in control, WeWork's challenges persisted and intensified. The company continued to rack up massive losses, struggling to find a path to profitability in a market that had cooled significantly. The COVID-19 pandemic, which forced millions globally to work from home, delivered another devastating blow, emptying co-working spaces and further highlighting the inherent risks of WeWork's long-term lease strategy. Despite efforts to cut costs, renegotiate leases, and streamline operations, the structural issues of high overheads and declining demand proved insurmountable, setting the stage for its eventual collapse. Ultimately, WeWork's attempts to right the ship proved insufficient. On November 6, 2023, the company filed for Chapter 11 bankruptcy protection in the United States. This move marked the end of an era for a company that had once symbolized the future of work and the power of venture capital. The bankruptcy filing, however, wasn't a liquidation. It was a strategic maneuver to restructure its overwhelming debt and renegotiate or terminate thousands of burdensome lease agreements that had been signed during its aggressive growth phase. It signals a desperate attempt to shed its most unprofitable locations and emerge as a leaner, more sustainable entity. As part of its Chapter 11 proceedings, WeWork announced plans to terminate approximately 90 leases globally and renegotiate many others, aiming to significantly reduce its long-term financial commitments. This process is critical for its survival, as shedding unprofitable locations is the only viable path to operational efficiency. The company aims to emerge from bankruptcy by mid-2024, albeit as a shadow of its former self, with a smaller footprint and a more cautious approach to expansion. The strategy now centers on profitability and sustainable growth, a stark contrast to the growth at all costs ethos that defined its earlier years. For SoftBank, WeWork became one of its most painful and expensive lessons. By 2020, SoftBank had already written down $11.5 billion on its investment in WeWork, a figure that only grew as the company spiraled towards bankruptcy. Masayoshi Son's once unbridled optimism gave way to public admissions of poor judgment, particularly regarding his initial assessment of Adam Neumann. The WeWork saga highlighted the immense risks inherent in the Vision Fund's strategy of pouring vast sums into high-growth and proven startups without sufficient due diligence and governance oversight, costing SoftBank and its investors billions. The WeWork story is a cautionary tale, offering crucial lessons for founders, investors, and the broader business community. It underscores the critical difference between perceived value and fundamental economic reality. The attempt to rebrand a real estate business as a tech company to justify inflated valuations ultimately failed. It highlights the dangers of unchecked founder control, weak corporate governance, and the growth at all costs mentality when detached from a clear path to profitability. WeWork's spectacular rise and fall serve as a stark reminder that even the most compelling visions must eventually confront the immutable laws of sustainable business practices.